All right. Good evening, everyone. Thank you for everyone who's here joining us tonight. My name is Lisa Partida with Home in LA. I'm the resource coordinator for the Lifting People Up Citywide program. So tonight we have our second session presented by Operation Hope, Isabel Duran and Rosa Amaya. And tonight's topic is going to be loan approval. So I'll go ahead and pass it along to the gals.
Okay. All right. Master lender. Or do you want me to introduce?
Yes, you have to introduce.
Oh, I'm so sorry. I'm so sorry. Okay, folks, remember we left off with credit counseling and credit repair. So let's say that you fixed your credit, you paid everything down, you paid everything on time, and your score looks good. So let's talk to the lender and see if we can get an estimate on the mortgage. Maybe we can get a pre-approval. So we're going to cover topics like what is a mortgage? What are the steps involved in obtaining a mortgage loan? Getting approved for a loan? How much is the lender willing to lend? How do you know if you are ready to buy? Calculating qualification. How do you increase your borrowing power? Oh boy. Let's find out. Yay. Loan approval process. Okay, Amaya.
It's okay. I'll take Amanda. I like the name. I like the name. If not, I would have been jumping up into the sky. Well, thank you everyone for being here today. It's a pleasure. Thank you, Lisa, for having us, Isabel, for the invitation in participating. Definitely one of the best things that you can do when you're in the process of buying a house or thinking and preparing is attending a home buyers workshop. And Isabel and Operation Hope do an amazing job at guiding you through the whole process. So we want to make sure that you understand the process. It's a big step. It's a roller coaster, just like this little process shows sideways. The roller coaster of buying a house is up and down and all kinds of feelings. And we definitely want to make sure that you understand where you're headed. It's a big step. So definitely being able to guide you in and give you enough information for you to make the right choice is definitely our goal and also Operation Hope's goal. A little bit of me, my experience. I worked with Operation Hope for 16 years in the past and then joined the banking financial institutions directly. They said I went to the dark side, but no, it's actually the light side. We get to give you the process of here you are, this is how much you qualify for, and letting you know you're approved, and we're ready for documents. We need your money. We need all this process, giving you a hand. It's definitely one thing that I love to do. And like I tell everyone, I didn't leave my nonprofit heart when I left Operation Hope. My feeling is we must help first-time home buyers. So finding you assistance to help you buy a house, it's definitely my goal as well. All right, so let's talk about the loan process. The first step is doing the research, talking to your lender, to your banking institution, talking with your counselor, which would be Isabel here at Operation Hope. We're here, she's here to guide you and help you. So definitely we want to make sure that you get enough information, finding out about the different loan programs are available. A lot of the times getting the referral from a family member is great, but also you also have to think about how long ago did they buy a house? If it was your parents who bought a house 20 years ago, almost 30 years ago, it's a different process. Back in the day, there were so many programs available. Interest rates were high, certain things were not done. I helped a gentleman to do a refinance, and he said, when I bought my house, the appraiser came and took pictures of my neighbor's house instead of mine. I said, whoa, how did that happen? But he says that's how his loan got approved, with the neighbors' photos. And I'm like, whoa, don't tell that to anybody. But definitely making sure that you understand the process now, because the process has changed and it will continue to change. We have updates every year in regards to loan programs, loan process requirements, ever since the housing meltdown that we had in 2007, 2008, things have changed dramatically. So we want to make sure that you have the options, that you have the opportunity, and be able to know this is what's available for me. This meets my need, because whatever fulfills what I need, it's not the same needs that you may have as far as financing, or Lisa's financing needs, or Arlene's financing needs. Definitely everyone's is different. So we want to make sure that you do that search, and we're here to answer them. What intakes in the process? Once you have done your research and you have decided, okay, I'm ready to submit my loan application for a review for pre-approval, then that would be the next step. Sitting down with the loan officer so that they could do the calculation and see how much you qualify for. Sometimes we'll do just a scenario process, which could be a pre-qualification and then a pre-approval. Two total different processes. But once you look at those numbers, you're like, okay, I'm ready to move forward and submit my full application into the loan officer so that they could go ahead and do the underwriting process. The loan officer submits those documents in. You have the loan processor who does the verification of the documents that we have collected. When we say verification, we mean they literally send emails to your HR department. If they have to get copies of documents from the bank, they will get verification of deposits of bank accounts, savings funds. It's very important to have all that information as changes have happened. We have to make sure that everything is documented. So that's the job of the loan processor. We submit the documents, they verify everything, and then they send a file to the underwriter for final review and approval. That underwriter looks at the bank's interest and they verify, is this borrower actually qualifying and meeting all the requirements that the bank has? It's not so much, do you have a good credit score, or do you have the money to pay down? It's everything together. Does the credit score that you have meet the program requirements? Does the debt to income ratio meet the program requirements? Does your income meet the ability of you to being able to pay this mortgage? So that's their job, to make sure that they take care of the bank's interest, but also yours. Because if we were to approve you like back in the days where breathe in this mirror and see if you qualify, you're ready to go, let's get your loan submitted, you would be back in the position in 2008 where people lost their homes because they actually did not qualify for those loans. So definitely we want to make sure, the underwriter wants to make sure that everything's there. The processor assists on that. And if we get the approval and we meet everything, then we get the loan approval. Sometimes we might get a loan approval with some conditions. Provide me explanation of this deposit, provide me an updated verification of income, provide updated HR information. What is this deposit here? Where did this money come from? Send me sample of blood. Just kidding, not blood, okay? We don't ask for that. We're not vampires, but definitely they'll ask for every detailed information as possible that they need in order to make sure that they're making the right decision. And there's times where if we get a denial for some reason, there's sometimes a second look department that will review the file. And if we're able to provide compensating factors, we're able to overturn those decisions, but we have to have strong compensating factors. Why is it that we believe that this borrower deserves to get that pre-approval, or why we should be considering other factors and not just what the underwriter saw. So definitely once all those are clear, then we go into the closing process. We have you go and sign your loan documents. During this process, we also have what's called the appraisal review, inspection, repairs, and if we're using down payment assistance programs, all that is done from the process of loan processing all the way to the approval. Sometimes we're able to get our loan approval before we get down payment assistance approval. So I'm working on a file right now. We've had our loan approval since, I'm gonna say March 12th. And I've been working with the city and other down payment assistance programs to get their approvals as well. I have the cities, and I just received today the final one, which is a grant and other funds that they have available for a client. So we're moving into now the closing process, getting the borrower ready to sign their loan documents, verifying that nothing has changed. Remember, I said we received the loan approval from our side on March 12th. It's been over 20 days since we've had that approval. So there's things that we need to verify that hasn't changed. And that's the loan processor's responsibility to verify during this closing process here. Make sure. So what I tell people is from the moment that we give you your loan pre-approval and we have submitted your application, even though you have a loan pre-approval, and even if you get your loan approval from the underwriter, do not go out and buy anything. Maintain your credit as it is at the moment that you submitted your loan application. Because some people get excited, okay, I have loan approval, we're ready to go, hooray, hey, I'm almost gonna get my key. But really, at the time of closing, 7 to 10 days before your loan closes, the underwriter can do a soft pull of your credit report to see if anything has changed. And if you have new debts, if you went out and bought that furniture that you wanted, that patio set, or the washer, dryer, refrigerator, stove, because you want to make sure everything was stainless steel at the house, that's going to really hurt your pre-approval process because now your numbers change. So nothing has to change from the moment of pre-approval to the day that you get your keys. After you have your keys, you could go and shop whatever you want. Or after you wire your money, at that time, we could pretty much say, okay, it's done at the time of wiring the funds. But prior to that, do not change anything. Do not breathe outside of what you already have in your budget. So let's go on to the next, so we could talk a little bit more about these processes that you're going to be going into.
Okay.
So I mentioned pre-qualification and pre-approval, two different things, completely different from one another. Right, do not open any new credit cards. It's very important because it's going to change your credit score. It's going to change because once you run your credit for a new time, it'll drop your credit score a lot of the time. So do not open up any new accounts unless we're letting you know, hey, you don't have enough credit account established. You may need a third account, then go ahead. But other than that, leave your accounts alone because your credit score will drop before it starts going up when you first open accounts. So pre-qualification, it's the difference between a pre-qualification and a pre-approval. A pre-qualification, I could bring up my computer right now, put a worksheet that we use. You tell me, this is my income, this is my debt, this is what my credit score is, Rosa, give or take. I could run some numbers and I could tell you, okay, here's your pre-approval, pre-qualification numbers. This is what you may qualify for. I did not verify income. I did not verify your credit report. I do not know what are the total debts that you have. You might have forgotten, oh, I pay or I co-sign for my niece's car and that payment is done by her, or she gives me the money and I pay the account. Two different concepts there. If she pays for the account, that's her debt. We could go ahead and show proof that she's paying that debt. But if she gives you the money and you pay that on your own, that's considered your debt because there's no way to show that somebody else is paying that unless they're transferring the money to you, the exact amount. And it's a whole deal of verifying the money that's coming in. And even then, sometimes the underwriters do not want to do it. They want to see that the account is being paid from that person's account. So definitely very important to have verification. So here we're not verifying anything. Next slide. When we do the full pre-approval process, we're going to request from you to provide us with
Come on.
next page, please.
Wait a minute. Where are we?
Pre-approval. Are we missing one? Oh, next one.
Come on. Here we go.
Here we go. The difference between the pre-qualification and pre-approval is that you're going to provide all your documentation. I'm going to ask for pay stubs. I'm going to ask for bank statements, for W-2s. We're going to run the credit report, and I'm going to submit your file into our desktop underwriting system. So when we take your information, there's a magic system where we input the information, and it has all these guidelines, and we wink at it, and sometimes it gives us an approval. When we're upset or mad, sometimes it won't give us one. I'm just kidding. That's not the way it works. We input all the information, and it gives us the exact. So there's no tricks there. The system has the guidelines already for every program. So let's say we work with a specific product, an FHA government guarantee loan, and we say this is what this person qualifies based on their credit. We see the basic requirements and we submit it under that program. So that program is going to review everything that we've requested, credit report, we've uploaded the pay stubs, we've uploaded W-2s, and it confirms based on what you have provided, this borrower does qualify for this loan, and we're able to issue a full pre-approval letter because we have provided all the documents that are basic for that system to be able to issue. There's times that it might not like the numbers, even though it looks pretty good. Sometimes they might not like a number and say, we don't like the debt to income ratio. And we'll talk about what that debt to income ratio is in a minute. Even though to us, it still looks good, in the back, it's running some numbers that it might not like, and that's why it's not giving us an approval. We have to go back in and verify all that and clear it so that we can provide that pre-approval. Sometimes we have to submit the file to the underwriter to verify it and give us the okay if we still can't clear those items. But pretty much most of the time, I'm going to say 90% of the times, it's an easy fix. We get it ready, and then we'll still submit it to the underwriter so that they can say, yes, you did a good job on clearing that, Rosa. Let's move forward with this pre-approval. So we may give you a pre-approval before the underwriter may look at it. So it's very important to look at that. But if we get you a full pre-approval from the underwriter, you're good to go. Pretty much you're going out and looking to buy a house with cash because the underwriter has said, I agree with these numbers, and let's move forward with issuing this pre-approval. So everything gets verified at this time in the pre-approval process. So difference, full documentation, no documentation on the pre-approval. Next.
Oh, man. Come on.
There's the 4 C's of lending that's considering this portion as well. So remember what I mentioned, it has the program requirements established in the systems when we're running the pre-approval process. So we're going to consider your credit, your capacity, the capital, and collateral. What do each one of these words mean? Let's go on to the next page. The credit definitely is going to be everything in regards to your credit profile, everything that's on your 3 credit reports. There's 3 agencies, as you guys learned earlier through the workshop. There's Experian, TransUnion, and Equifax. But the credit report that we request is a little bit more detailed. Even though as a consumer, you may see information, oh, my credit report looks awesome. When we run the credit report, there's a little bit more history on there that we get, what's called a mortgage loan, a mortgage credit profile. So it gives us more details. We don't get to see your rents, but we definitely see a little bit more history on the credit report. Oh, I think I got stuck. Give me 1 second, guys.
Uh-oh.
I'm here. It's just that it says I'm leaving the meeting and I'm still here. Okay, I'll leave it there. If you guys see me looking up, I connected my computer to my other monitors and it's going crazy. Okay.
You disappeared.
Okay, you guys will see that beautiful house in my background.
Yes.
Let's see. There we go. You guys are not going to see me exactly. Trying to fix this. Okay, let's see if that would work. All right. So what's part of that credit this a part of the credit lending concept. We're gonna see how do you pay your bills? Do you pay them on time or are you late? If you have any collections, if you have any public records, if you have any debt that's outstanding. And so, as I mentioned, it's not just the credit score and the accounts, it's overall history that we're going to be able to review on there. If you have current debts, we're going to see if you have installment accounts, revolving accounts, or any other type of payments such as student loans, personal loans, anything else that may be showing up on the credit report, child support. If you have filed bankruptcy, sometimes some areas in the country, they will report felonies as well. So all of that will show on your credit report. We're gonna, when it comes to the capacity, how much income do you make? How much income do you make throughout the month, throughout the year, throughout the past 2 years? So we want to see consistency for the past 2 years in regards to your income. So it's not just how much money you're making right now, but has that income been consistent for the past 2 years? And also, if you owe any money from that income, if you had a 401k, you took any loans, some banks will count those debts that you may have as part of your, if you have any loans from your 401k, they'll show on there. Or if you have child support, it'll show on there as well. Sometimes people will not disclose it. Here's where we catch it on your pay stubs. We're able to see if you owe any money. And also if you have any other liabilities, tax liens as well. If you have to pay any taxes, we're gonna see it on there as well. Next.
Okay. Do you see that?
Oh, I didn't see the switch, but I see it. Capital. We're gonna see how much money you have saved. You're gonna need to have at least, depending on the loan program that you're using, you may be required to use at least 1% of your own funds for the down payment. Some bank products may require 3%. Other programs may require 5 or 10. So it all depends on what program you are using in order to qualify for this purchase. We're gonna need also to see if you have enough money for the loan fees. There's an application fee, credit report fee, there's transaction fees, processing fee, all that fee that's part of the banks, as well as the fees from escrow, closing costs from title company that you're gonna need to have because you have to have title insurance on your loan. It's required for you to go ahead and have that information showing that you have enough money. What we tell people is you want to have at least 3%, 3 to 6% of your own funds for the total transaction. So 3 to 6% of the purchase price for the transaction. Escrow impounds, those escrows are going to be your property taxes that we have to collect. Remember, if you're buying a house right now in April, are we in April? Yes, in April. You're not going to pay property taxes until November, but there is something that's called a supplemental that you have to be aware of as well, that you're going to have to pay next year. But we have to collect enough money to pay your property taxes in November. But let's say if you were to close your loan transaction in August. So property taxes are due in November. So if you close in August, your first payment won't be until September. And we have to pay the property taxes in this November. So if your first payment is in September because you closed in August, or actually no, if you close in August, your first payment usually won't be until October. So we're talking about only 1 month worth of property taxes that you're gonna pay through your regular payment. So we have to have enough money to pay the property taxes. So we try to collect enough, which we need 6 months of property taxes. Even though you have not owned the house for 6 months, those property taxes that are due in November have to be covered by you, the new homeowner. So it's very important to know that you're gonna have to have enough money to cover that as well. Some banks may require reserves. Some banks may require for you to have 3 to 6 months reserves. Some banks may require for you to show that you have enough money for your moving expenses. That's not really a requirement that we're gonna see on the 4Cs from most lenders, but just in case you do want to have enough money because you're going to need to move. And that movement means the moving truck, buying new appliances, changes, the utility bills being transferred under your name, which may require a deposit, or you may not. So we want to make sure that you have enough money for expenses. You don't want to be going paycheck to paycheck to be able to move as well and have this transaction cost you every bit of penny that you're earning. Collateral, we're going to verify that the property is actually worth the amount that it's being sold for. So it is the bank's responsibility or the financing institution's responsibility to request an appraisal of the property to confirm. And that is a third-party individual that we're going to hire. We don't even get to contact them. We send the request in. The client is ready to submit the appraisal. They've opened escrow. We're ready to move forward. And there's a third person that will request that appraisal. We never get to contact that person. They're going to verify that the property is in good condition and that you don't have to do too many repairs. As a first-time home buyers, it's very important to have this appraisal and do not waive your appraisal inspection as well, because let's say during that appraisal that they go out and do, the value of the property comes in lower, or the appraiser finds that there's a lot of roof issues or foundation issues. We were at an open house a couple of days ago, and as this person came in, they saw very clearly that there was a slant on one side of the corner of the house, and I was standing right by it. So I kind of felt it a couple of times, but some things are very obvious, and foundation is a major expense. And that's why the appraisal has to go out to give you the details. If the appraisal comes lower and you have waived your appraisal and all the things that they say that need to be fixed, now you don't have the right to go back and fight for, oh, I need these items repaired, these foundation issues, there's some roofing issues or electrical or plumbing issues. If all those things come up, or one of those comes up, which is major expenses, if you waive your appraisal, you're definitely giving up your right to be able to go back and negotiate. If the appraisal value comes lower, if you waive your appraisal rights, you lose the right to be able to go back and say, hey, the appraisal came back lower. I want to go ahead and submit you a best offer, saying instead of $650, I want to offer you $620, which is the actual value, because the bank is going to finance based on the actual value, not on the sales price. So that means you would have to come in with your with the difference of the funds. So the value came in at $620, you're going to have to come in with that difference. If the sales price is $650, you'll have to come in with an additional $30,000 plus your 1% of the value of the home. So that can get a little expensive, not only on the financing part, but also on the fact that the property may need all those repairs. So be very careful. I saw a question, but I'm covering it. Let's see. Let's cover that question while Isabel changes to the next one.
Okay. Okay. Yeah. Determining qualification. So
All
we
right.
look at credit scores, we look at loan to value, income, debt ratios, employment history. What is loan to value?
It's very important to know these terms. Let me answer that question. Do you have to add money into your mortgage account to cover property taxes? Most of the time you don't, but what happens is if there's an assessment done, which usually the assessment of the property taxes or of your impound account will be conducted yearly. If they say, oh, we're sorry, the property taxes were not calculated correctly, or your property had what's called a Mello-Roos, it's an additional property tax that's added in new developments that might not have been calculated correctly. So, or property taxes were just not collected and there wasn't enough collected to cover, and the bank cover your payment, then they have to collect that money from you. So they can send you a statement of your assessment of your impound account assessment showing this is what we collected, which what was collected from your monthly payment. This is what we have paid out to the property taxes, home insurance, and we have a shortage, which means we're going to go ahead and either you, the buyer, could send a check in for the full amount, or they will add it into your monthly payments, and your monthly mortgage payment will go up. Your payment can also go up if the property taxes go up. So let's say, as we have seen lately, that property values have gone up, the assessor's office will send us a statement saying, hey, the value on this property has gone up. Here's the new statement showing what the value is. So we have to, the bank has to adjust the impounds and collect a little bit more, but they will let you know with plenty advance. Usually those will go out like around June to let you know we received this from the property assessor's office, and by November we have to have this much money, which means we have to break that a monthly payment into your new mortgage by this amount. So you'll get enough notice in regards to that. That one's a really good question, but be prepared that it can happen. It doesn't happen a lot. Usually you will see if you refinance, your property value will go up, so you'll get that. Or right now that we have seen property values going up consistently, the assessor's office is sending that, and they're trying to collect more money for the states too. So or your county. So they're trying to get that money, but they're also investing back into the community. So determining the qualifications for this loan. So not only is your credit score impacting the qualification amount, your income, your employment history, but also something that's called the loan to value and the debt to income ratio. So we talked about credit, we talked about income and the employment history. The loan to value is, do we have a slide for that one exactly that we can
Yes.
share?
Yes,
The
we
next
do.
one? Okay, so,
So this is-
okay, so we'll talk about the debt ratio first. So the debt ratio is the percentage of income that is being used to pay the debt that you are going to be acquiring, one, for your housing payment, which includes principal, interest, taxes, and insurance. And if you're buying a condominium, you're going to have also what's called an association dues, which maintains the outside of the property, and they would take care of the building itself. So if you have a pool, if you have if you have a common area where you could, or like a little park recreation center, all of that is taken care of by the association. Sometimes they'll cover part of your electricity bill or your internet or the water. So it all depends whatever the association covers. That is also part of your payment debt ratio that we have to calculate, because we as the bank cannot exceed certain limits that the bank allows us to do. FHA does not allow us to go over 36 over 45. It's actually 46 on the back end. So that 36 means that's your housing payment. With the changes and the programs, they have been a little bit more flexible, and they let us go up to 45 over 55. So when we say 45 over 55, 45, the lower number is always going to be your housing payment, whatever the monthly projected mortgage payment would be, which would be principal, interest, taxes, and insurance, and the HOA. The back end ratio is the total debts, including the projected mortgage payment. So if you have a car payment, student loans, personal loans, credit card debts, plus the projected mortgage payment, we cannot go over 55%. I know here we have 50% because that's really what we should be looking at, and that's like already pushing. But FHA has allowed us to go up to 55. There's some crazy programs out there that will allow you to go up to 60. Us, the first-time home buyers, should be staying within this 45 over 50. Why? Because we are using your gross income to calculate your mortgage approval, okay? If we're using your gross income, remember, your take home is a net number. So already we're putting you in a negative number because that's what the state and the government says. We have to use the gross income. But you are the one that's going to pay these mortgage payments. So you're the one that has to say, Rosa, I know you can't qualify me for a payment of $3,000, but really my take home is only 4,500. So I'm only gonna have left 1,500 for water bills. I mean, for utility bills, for food, for car, gas expenses, and that's not gonna cover everything. So can we drop my payment by this much? Or Rosa, you barely are touching my income. Can you push it a little bit more? It all depends on your income. Because remember, it's gross net. My numbers are going to go based on gross. You, as you're budgeting, have to look at your net to make sure that that payment feels comfortable to you, because Isabel has a mortgage payment, Lisa has her own mortgage payment, and I have my own mortgage payment. So we can give you all the counseling that we can, but we cannot give you any of our money. So sorry. Next.
Next. Oh, come on.
Next, determining your qualification. When we talk about income, we're gonna take the last 2 years of your income. If you have been in the same field, that's awesome. We want that stability that shows to the bank that you're not jumping around from different industries or different jobs, unless you're jumping around for a better salary. I've had people that say, oh, well, I'm a nurse, and at this place they were only paying me this much and giving me this many hours. Now that I've gained more experience, this company is giving me more money and I'm able to get more salary. So that's a plus. We want to see that. Most programs require proof of income, such as pay stubs, paycheck stubs, and tax returns. We're also going to review your W-2s. And again, if there's a change of the income drastically moving up, it's a good thing. If it's going down, we're going to ask what happened. And a simple explanation that makes sense is okay. Not, oh, I just didn't feel like working the rest of the year and I took a break. Now I'm back to my employer. But if you had a legitimate situation, sickness, hours were cut for a reason at work because your department was changing, those are things that they will take. But now you have stability, we'll move forward with that. For self-employed individuals, we're going to want to see 2 years of tax returns, 3 years sometimes, but definitely the 2-year stability is what we're looking for. Next. Arlene, your question about how much money you should have saved. I tell individuals, let's calculate the numbers and we're going to look at 3 to 6% of the purchase price. So if you're looking to buy a house of 500,000, let's do like 4%. So that means you would have to have 20,000. Some money for your down and some money for your closing costs. If you have money left over, wonderful. You'll have money left over because we use the down payment assistance. Because remember, we're going to try to help you with getting some down payment assistance money so that you don't have to come out of pocket with all the funds. Okay, so we're going to make sure that you keep some money. What is the loan to value word that we mentioned earlier? That LTV is very important because that determines how much the value of the house is and what is the purchase price and the loan amount that you're going to be receiving. So in this example, the appraised value of the home, it's 110,000. The purchase contract or the sales price of the property is 100,000. You're going to be obtaining a loan for 80,000, which means you're putting 20% down. And when we give you this example, it doesn't mean all the money has to come out of your pocket. There are some down payment assistance programs that we can assist you with that can help you with that. So depending on what program you qualify for, that $20,000 could be assistance program. So that means if we take 80,000 and of the loan amount and divide it by 100, that gives us 80% loan to value. And that a lot of the times will impact or loan approval. Most banks will say, well, we can only do 3.5%, or we can do a product that's 1% down. But there's other assistance program. Most programs will require at least 3% down total. So it depends on the loan program that you're looking to apply for, but there are some banks that may offer like 100% financing, but they're using a grant or they're using down payment assistance program to cover that. We haven't seen true 100% financing for a minute now, but we're hoping that some banks will bring it. So let's bring it next. Arlene, did I cover your question? Yes. All right. Determining more of the qualification credit score. Some banks will require that you have a minimum 580 credit score. And it's so funny. The other day we were pricing a loan and we hadn't run the credit report yet. When we ran the credit, because the borrower didn't want us to run the credit. When we finally ran the credit report, the borrower had a 566 credit score. And guess what? We were able to price it and give a loan to that individual. He did not have bad accounts. What he had was very few accounts and he just wasn't using them. He had 2 accounts and very little limits. He had opened them a long time ago and hadn't used them, but that 566 credit score was still there. So we guided him to start using it so we can see some activity. But we were able to move forward with the loan pricing and gave them a loan pre-approval. We hope that by the time he finds a house and we have to run the credit report again, he might be in the 600s because we provided him use the accounts, show some activity, and we should see how it's going. He's been looking for 2 months now. So by the time that he opens escrow, we might have to run the credit report again. So hopefully we'll see the changes. If you have a higher credit score, the maximum credit score that you can have is an 850. So definitely there are more possibilities for you to be able to get a better interest rate, better loan programs. Right now, definitely having a higher credit score will help you with the interest rates. Being able to see where we price the loan, it would be much better for someone that has a higher credit score. And when I say price it is when we submit the file to the system, we have to select the loan product and it'll tell us this is where you're starting as far as the interest rate. And they will let us know how low we can go on the interest so that it won't cost you so much money. And that's with every bank. Every bank has a percentage of points that you can charge, that you have to pay in order to get that interest rate. Whenever you hear the word par, this is the interest rate at par. It means no points, but it can be a really high interest rate. But if you pay some points, that can help you lower that interest rate. How to calculate that debt to income ratio? Remember, I mentioned we're going to take your gross income. So if we have an individual that makes $60,000 a year, and we divide that by 12, that individual's income is $5,000. And if we multiply that times 45%, that number would be $2,250. That's what their monthly mortgage payment can be. Principal, interest, taxes, and insurance. When we calculate the number, if that's the maximum that individual can make, we can only run the numbers a certain way to keep it there. And if that's their comfort level, if you have a co-signer, if you have a co-borrower that comes in with you, that could change those numbers. So definitely it's very important to review that. If you have debts, then we take those debts away from that 45% and it will drop your purchase power. So it's very important to try to pay off items so that you have the minimum debt possible so that you can maximize your purchase power. Let's see, Arlene, where can I use the money, such in what cities can I use the money? Such as 100,000 that's been offered. So the city of LA has a program that offers up to 161. Some cities will offer their own program for that specific city, such as the home money that's offered by the city of Azusa, and I believe Rosemead has those funds. City of LA, it does say City of LA, but it also has some community, some surrounding areas as well. And we'll talk about that one, not sure if today or another day, but right now, California Dream for All program is a big deal because you can buy a house anywhere in the state of California and receive that assistance. And the income limits per area, it's a little bit different. So that's a really good program right now. And it's hot potato because they just opened up the portal for you to submit for your reservation, as it will be a lottery, and it's going to close in April 29th, on April 29th. So definitely it's a program that you may want to look into because it gives you more opportunities as far as the areas where it's going to be available. Next. I think it's a lot of information. I feel like I'm sharing a lot more today.
Yay.
No? Yeah. We're almost there. We're almost there, I think. Cut me off if I'm going too far. Okay.
Okay.
Choosing your lender, referrals. I'm definitely talking to Isabel. She worked with different banking institutions and also talking to your bank. So talking to your direct bank, talking to either a lender or a broker. There's a difference between a lender and a broker, okay? I'm a direct lender because we provide our own financing. Even though you might see that your loan gets sold to another company during the process, we're a direct lender. A broker is a third-party individual that will go to us or a bank, different banks, to try to obtain the financing that you need and charge you a percentage for helping you with that process. So it's a little bit better when you go directly to a lender, a bank, a mortgage company like us, because we're direct lenders. We do not charge you a third-party fee. There's just the application fee and the bank fees or the financing fees, but not an additional fee on top of that. You could also go to the HUD website to be able to get information about some of the banking institutions that are available or the financing institutions. Next.
Rosa, do you have a license as a mortgage officer?
I do. Of course I do. And I am proud to say that I passed my test Monday of last week. When you work for a bank, the bank provides you your NMLS number. But when you work for a mortgage company like the one I'm working for right now, New American Funding, you have to get your own license. So we have to study hard for days and hours, and you have to take a test for 3 hours. It's 120 questions, and you have to pass it with a minimum of 75%. And yours true here passed her test. So I'm super excited. I could go anywhere now, whether it's a bank, a mortgage company, a broker. Woo-hoo! I'm excited. So thank you for that question, Isabel.
Very good. Yeah, because
And
I
you
tell
get
the
to
people.
carry.
What?
I said you get to carry that NMLS number with you for the rest of your life, just like your social number. So any loan that I did at the bank follows me if something goes wrong with it. The same thing working for a broker, unless I just stop by working completely in the lending institutions.
Great.
So super excited about that.
I would be too. God, they're hard tests, you know?
They are.
Okay.
They're very hard.
Okay.
Yep.
So
Next,
you want documents.
some of the documents that we're going to need in order for you to submit your loan application will be your pay stubs, the 3 most recent pay stubs. So if you get paid weekly, we need 4. If you get paid monthly, we still need 3. If you get paid bi-weekly, we're going to need 3 pay stubs, the last 3. And please provide them consecutive months. I mean, consecutive pay stubs. Do not give me one for January, one for February, one for March. I need the last 3 consecutive ones. If you received Social Security benefits, we need, or disability benefits, we need that award letter that they sent to you, the most recent one. You don't have to go in and log in, but if you have one that's within the last 60 days or the one that they sent you last, we want that. If you do not have it handy, we do want you to go in and log in. It's an easy process. You could always get it online. If you have, we're gonna need a copy of your Social Security card and your picture ID as well. We're gonna need to see sources of your down payment. Where are you saving your money? Where has your money been ever since 9/11? We definitely need to see sourcing the funds so that we see that it's legitimate money. If you have money at home, put it in your bank account. We need to see it that it's been in your account at least for 60 days. So please go ahead and put your money in the account. I still have run into some people that tell me, I have $300,000 at home. Please, how do I put it in? I'm gonna pull my hair, and I already have gray hairs. I cannot be bald, okay? We need tax returns for the past 2 years. We need W-2s as well for the past 2 years, and we're gonna need the bank statements, 2 to 3 months bank statements. All pages, please. This is the reason for the sourcing of your down payment. We need all the pages, even the ones that say left blank intentionally, but it's page 6 of 10. Or I'm sorry, 6 of 6, that's a blank page. We need those pages. Or if the pages are double-sided and they're still blank, we want all the pages. If you have a 401k, if you have a retirement account, a CD account, and those are funds that you're going to be using for your down payment, we want to see the last quarter of that statement. If we're going to be applying for a down payment assistance program, most of those down payment assistance programs will need 3 years of taxes, 3 years of W-2, 6 months of bank statements. But once we do your pre-approval, we'll know where we're putting you, what program you may be able to apply for, or the multiple programs that we may be able to apply for, then we'll let you know we need additional documents. But at least for the beginning process, we need what's on here. Next. These are your sources of down payment. I mentioned already, if it's from a savings account, retirement account, if you're going to be selling a car, if you had a piece of land back home that you're going to be selling and bringing the money here, we need to see a bill of sale for that transaction. If we're going to be using down payment assistance program, I'll help you with that and take care of that. If you're going to receive gift funds from a family member, we need to receive a gift letter from them and also receive a bank statement that shows that they have the money in their account. So very important to source where your money is coming from. We're going to ask you for blood. I'm just kidding. We won't ask you for blood. Next.
Okay, I think this is the last slide.
That's the last slide. Okay, awesome, guys. So thank you so much. Just one brief thing about some of the programs that we're working with for the future. There's a grant available right now that's a first come, first serve. Once you're in escrow, it's $35,000. I'm very happy to say that I have been able to get 2 of my clients into the program already and ready to close them with some city assistance, other funds available. So the client is getting a good deal, and hopefully we'll be able to share her story, her success story at the next workshop or at another event that we have.
Wow, that's exciting.
We're very excited. So there's money for all of the LA County areas with that grant. And now that things have changed with real estates and paying their commission, that money can be used towards that as well. So we're very happy that that's available.
That's great.
Cool.
It's really turned positive this year for home ownership. That's great.
It's moving along. We're happy, even though there's some changes coming on where the buyers are going to have to pay the commission to the seller, but we're going to have that possibility of using some of the grants. So that's a great thing.
Great.
Yes, Lisa. There's a lawsuit that happened last year that was brought in by some sellers, and the judge ruled towards their favor. So now the seller does not have to disclose that they're able to pay the commission for the buyer. So now the agents have to have a buyer, agent buyer agreement that the buyer will pay the commission.
Good.
So it's not a negative thing because
Uh-huh.
someone was still paying them. It's just that it didn't come out of the buyer's pocket back then. But there's things that hopefully will work out for us to be able to assist.
Okay.
Yeah, absolutely.
Yeah.
Thank you, Rosa.
Thank you
Thank
so
you
much,
guys.
Rosa.
Thank you, Arlene,
Yes.
for your felicitaciones. I'm super excited.
All right. All right. Well, the next session that we have is going to be finding a property, and that's going to be taking place next Tuesday at 6 p.m., right?
Right.
Yeah.
Right.
April 16th.
Awesome.
right.
Congratulations, guys. Good luck.
Thank you.
All right. Have a
All
good
right.
night.
Thank you.
Bye.
Okay. Bye-bye.